warm welcome to Global Mantra, the show that profiles prominent fund managers from the City of London and gets their views on the global market environment. Joining me on this show today is Sanjeev Shah from Fidelity International. He manages about $5 billion in a special situations fund, and he's right here in a very special occasion, the London Eye, which everybody knows about. So let's quickly get a quick perspective from him on what he makes of the current market environment. Sanjeev, it's great to have you on the show. Thanks very much for taking out the time. Given your understanding of the developed markets, what do you make of the outperformance the developed markets are showing versus emerging markets at this point in time?
Yeah, I mean, I'm of the belief that developed markets in the shorter term will continue to outperform emerging markets. I think the growth dynamic in the US and Europe has got the potential to surprise positively in the shorter term, given all the fiscal stimulus, all the monetary stimulus that has been injected into the economies. I think, secondly, on emerging markets, there's also the issue of cost inflation coming through in terms of food inflation, labour cost pressures, and also the cost of credit having gone up. And so I see continued monetary tightening in these markets, which I think will be a headwind in the shorter term in these markets. I think importantly as well, flows have come into emerging markets in 2009 and 2010, about $80 billion per annum, and those flows are starting to reverse now. So in the shorter term, I'm more positive on developed markets.
And what kind of potential upside are you seeing from these levels for developed markets? Because you understand those markets, you've been investing in European equities. What's the potential from here?
Okay, we've had a very strong rally in equities since March of 2009. And I think we're in the final stages in the shorter term in terms of the rise in equity markets. And for that reason, at some point later on this year, I think we're likely to go into a longer-term consolidation phase. Although I remain positive on equities over a longer-term perspective, I think in the shorter term we're at the final stages of the rise in equity markets.
At the fund level, do you think there is more interest now coming in on making allocations to the developed market region as compared to the emerging markets?
Yeah, no, essentially, I mean, certainly since the start of this year, we've started to see flows into developed market equities. That's partly a function of the reversal out of emerging market funds, but it's also a reallocation from the likes of fixed income markets and corporate bond markets into equities as well.
What about investor confidence? Do you see that coming back for developed market equities?
Yes, I mean, it certainly has improved from the nadir we saw in sort of early 2009. I think that's reflected in flows coming back to developed market equities. I think there's also more and more business confidence now amongst corporates as well. So you've started to see a pickup, for example, in M&A activity across developed markets. And I think that's a function of business confidence starting to come back, but also, for example, financing markets opening up as well.
What are the main risks that people are facing or are worried about as far as developed market equities are concerned right now? Or, when you talk to your peers, what are the few things that come to mind when you're looking at the future of developed market equities?
I think the biggest issue is clearly the macro situation in a lot of developed markets. So whether you take Europe or the US, it's sort of unsustainable sort of fiscal positions, also trade positions as well. So for example, if you take Europe, I think there'll be continued focus on the bank and sovereign risk crisis in Europe and how that evolves going forward. I think it's going to be a long journey out of it, but that's certainly a very big focus for a lot of investors.
Also, you run a long-only fund. Do you think that the current market environment poses more challenges for a long-only fund compared to a long-short kind of a fund structure? Because there are a lot of dynamics out there, a lot of risks which are, plaguing the performance and the return expectations from the start of this year.
Look, whichever sort of market environment you take, there are always challenges. The challenges in early 2009 are different from the challenges that I face today. Just to make sure that you appreciate, I do run a long-only fund, but it's got UCITS 3 powers, which enables me to short individual names and also to use options and derivatives as well. But what are the challenges today and where do I see the opportunities? I think, first of all, today I think quality is priced as cheaply as it's ever been, versus a historical context. And so certainly you can buy quality companies at a much reduced premium valuation than his history would show you. So I'm certainly finding more opportunities in the quality end of the spectrum. Secondly, I think there are opportunities across different sectors, for example, in technology, which is benefiting from a dynamic such as the growth of mobile data, such as, for example, the rise in corporate capex, and also internet type, companies as well. So I think that's another opportunity. And I think the financial crisis itself has thrown up opportunities quite specifically in financial companies. You know, a lot of investors have moved away from this area, and I think that's created an opportunity to invest across the board in financial companies.
From the perspective of currencies, I mean, you're more bullish on the dollar, and the near-term outlook on the dollar is stronger?
Yeah, look, I mean, again, you know, my focus is very much, you know, stock specific, so I don't focus hugely on macro variables. But, you know, I would be more positive on the dollar than the euro, and my view on sterling would be somewhere in between that. Why is that? The dollar, I think, looks intrinsically undervalued on a purchasing power parity basis. I think sentiment has been very negative on the dollar, and I think that can change over time. And so there's some of the reasons, you know, why, you know, I'm more positive.
How much time? I mean, is there a consensus on the street about 6 months, 8 months?
I think, you know, on a sort of 2 to 3 year view, I'd be more positive on the dollar than the euro, definitely.
All right, Sanjeev, we'll take a short break on that note. So when we come back, we will talk about Europe and its equities in particular, and how Sanjeev is going about evaluating opportunities there.
I am of a belief that rates will remain lower for longer by the ECB. I think the situation in the peripheral geographies is so tough that actually for the ECB to be raising rates strongly at this point in time would really lead to an increase in the risk for the crisis as a whole, for the Eurozone as a whole. I continue to maintain my sort of underweight in the oil-exposed sort of stock. I think the large increase in prices that we've seen in the shorter term has been largely driven by speculation as opposed to fundamentally driven by demand and supply.